time value of money, we are talking about the worth of the money or the value of the money. The worth and the value of the money changed with the passage of time. For example, if you have 1,000 rupees and you are able to buy a particular kind of a products or a specified things, but after a few years you won't be able to buy that particular products because of so many reasons, because the worth of the price has been changed. If you go few years back, you might be able to buy particular things in 500 rupees, but today if you make a comparison, today you are not even able to buy these things into 500 rupees. Why? Because the price and the worth of the price has been changed. And what are the reason and why we are saying that the worth of the price has been changed? Because of so many reasons. Okay, so what is the time value of the money? Time value of money, if we explain it, so you can say this is the difference between what it is, difference between today and tomorrow worth of the price, worth of the price. So that's comparison basically is known as time value of money. So why the worth and the value of the money changed? We have so many reasons, or you can say there are so many things which are working behind this change. Number one, you can say the reason could be inflation. Number one, inflation. With the passage of time, the price of the products changed, or you can say it's become more expensive to buy. So if you make a comparison with their inflation, you can say that the worth of the price has been changed. As I mentioned before, that if you go a few years back, you would be able to buy, might be possible you can easily buy anything in 500 rupees. If you make a comparison with the today price, you can't even buy these things into the 500 rupees. And if you take it to the future, if you have, for example, 1,000 rupees and you are in a position to buy a particular product, but after a few years you won't be able to buy these things. Why? Because of the inflation. And what could be the other reason? The other reason is risk. Due to the uncertain situation and due to the uncertainty into almost everything, again the price of the value has been changed. You never know that what would be the situation, either it would be positive or it could be negative. So because of that uncertainty, that has an impact on the value of the money. Then third could be, might be possible, is you can say investment opportunities. Investment opportunities are another reason which basically impact the value of the money. If you have a high opportunities, then the worth of the money would again be changed. And if you don't have enough opportunities of the investment, then again you have a very less chance, but still it has an impact on the value of the money. And if we talk about from the individual perspective, so you can say your personal consumption preferences. If you want to spend your money on luxury products, then again the worth of the price would be changed. You need much more money because it all depends on your preferences. So that was some ideology which is working behind the worth of the money, or you can say which is essential part of the time value of the money. If we talk about some of its techniques, although I will discuss later in the class, but still I am just giving you some name that what kind of techniques we have or we use to calculate the time value of money. So we are talking about some of its technique. Please ignore the spelling. So what I'm saying that this is the technique. So what we have is number one, compounding. We normally said this is known as future value. I will let you know at the end of this lecture, or might be possible in the start of the second lecture, that what does it mean future value. And you just have to remember that we have basically two techniques to calculate value of the money. The number one is compounding, other one is discounting. So compounding, you can say the higher amount, something which is have higher rate, and discounting, as name suggests, something lesser in rate or have a less amount. So these are some techniques which we will read again and again. We will solve different questions in that subjects, on which basically based on the compounding and discounting, or you can say the present value and the future value. Okay, what next? If you look at the lectures, what would be the concept of the time value of money, how we divide that concepts, and what is the idea which is basically working behind the time value of money, or you can say this is the valuation concept. Valuation concept, we will explain them one by one. I am just giving you a hints that what does it mean and what are the main headings under these subheadings, or you can say what are the headings under these some different points. So valuation concept, number one, we have simple interest, and other one could be compound interest. Compound interest. So you should know before moving ahead that what is interest. Interest that is earned on a given deposit and has become the part of principal amount at the end of specific time period. For example, for instance, you are going to deposit 10,000 rupees in a bank. How much? 10,000. And bank said that they will give you, for instance, 10% on your deposits in each year, or let's say your deposit 10,000 for 1 year. How much? For 1 year. Bank said that you will get at the end of 1 year 10,000 and 10% your interest. So bank will charge you, or not only charge you, bank will pay you 10% on your investment. And what would be the amount? So let's say it's 100. So 10,000 plus 100. So you can say 10,000 and 100 you would be able to get after 1 year. Okay, this 100 is your interest, and this is known as your principal amount. This is known as your principal amount. For how many years? For 1 year. So what I said in defining the interest, that interest that is earned on a given deposit, interest that is earned on a given deposit becomes the part of that principal amount. Okay, so how much you were earning? 10%, and these 10% were 100. So that's become our principal amount. So at the end of 1 year, what we are getting? 10,000 our deposits and 100 rupees, or you can say based on our promise with the bank that they will give us 10% on our investments. So interest that is earned on a given deposit and has become the part of the principal amount at the end of specific time periods. Okay, so that's become a reason of the interest rate. So what I said, that what is interest basically? Now I'm saying that there are two types of interest: simple interest and the compound interest. Okay, let's see what is simple interest.